Thanks for joining us today on Market Call. I'm Morella Fernandez. Brianne Gardner on the show with us today, portfolio manager and senior wealth manager at Velocity Investment Partners of Raymond James. She'll take your questions today on North American large caps. Here's how to reach us. 1-855-326-6266 if you want to call in. Market Call at BNN Bloomberg.ca if you want to email a question in. Brianne, good to see you.
Yeah, thanks for having me as always, Marilla.
It feels like the market sentiment is shifting this week. What's your take on that?
Yeah, certainly. I think I 100% agree. This week, the tone in the markets shifted in a way that almost feels subtle at first, but increasingly hard to ignore. Right? What really started as a geopolitical backdrop is now feeding directly into how investors think about inflation, policy, and risk. I mean, in the U.S., you could see that adjustment unfold. Oil prices moved higher, yields followed, and equities, particularly the most crowded growth areas, became under pressure. And this didn't really feel like panic. It felt more like a recalibration. So when we start to see energy prices reacting to potential supply disruption, markets begin to price a different path forward, one where really inflation is a bit stickier and central banks have less room to ease. So, that unease ahead of the deadline for the peace deal with Iran also weighed in on markets as well.
Okay, so let's talk a little bit more about what you see down the line, because we have seen the spike in oil prices over several weeks now. Do you expect them to go even higher, and what else are you looking at?
Yeah, I think deadline that was scheduled for Saturday, if no deal was forthcoming, the U.S. would commence with attacking Iran's power plants. But we saw yesterday after the close, Trump saying that he has extended the deadline by 10 days to April 6th. So, I would say talks are ongoing. Trump is saying they're going very well, but I see both sides have big asks for a peace deal. So I'm watching closely the market and how the market, we believe, will focus on the Strait of Hormuz and the transportation of oil, as you mentioned. So if ships can pass through without almost a fear of being attacked, that should provide a little bit of relief to higher energy prices. And if Iranian attacks on surrounding neighbors and their energy facilities cease, that too would help lower prices. So, it's kind of in a wait and see, but we're kind of back in that, week 4 of this whole U.S.-Israel campaign against Iran. And I do see with lower energy prices should come higher equity prices. That would reduce the fear of higher oil and gas prices that are slowing down the economy, and also de-escalate the reignition, which would reduce the risk of this turning into a wider conflict, or at least a prolonged one.
Okay, so do you see the bull market ending?
No, at this point, no. I think, we see pullbacks. Pullbacks are healthy and normal right now. Decline, even a pullback, is defined as, a decline between 5 to 9.9%. And they happen, 3 to 4 times a year. What's still these corrections defined as a decline between 10 to 20%. So that happens about once a year. So yes, it can create uncertainty. And the one thing markets don't like is the unknown or uncertainty. So if we get clarity or any sort of guidance as to there is this peace deal that is going to form, I can see the markets taking off and taking off very quickly. So every bull market has corrections. It's part of the cycle. And right now this is falling into a normal correction for us. If things are prolonged, that could create sticky inflation, potentially cause interest rates to be pushed down the road. And so right now we're not there yet, but it is certainly something that we are watching from an economic standpoint.
All right, let's take a quick break then. We'll line up the first phone call for Brianne Gardner of Velocity Investment Partners. Again, she'll take your questions today on North American large caps. Here's how to reach us. Back in a moment. Let's start today with an email from Stu. He says, could you please give your views on Teck Resources and copper producers in general? How have some of them, we know gold and silver have been well off over the past couple of weeks with this movement up in oil. How is copper doing at this point?
Yeah, we have copper exposure, and I still like copper. I'm bullish on copper. We don't own Teck Resources directly in the portfolio. And even precious metals positions, we still like Barrick, Wheaton, precious metals, et cetera. I think Teck is one of the more interesting ways to play copper in Canada. But I think execution risk keeps us watching rather than owning. As you can see, a healthy pullback in the stock there, trading around that kind of $67 with a price target, though, of near 90. So there is some upside here, but you need to believe in, I think, the merger and the mine ramp up. So the story right now is that copper has gone from more of a cyclical metal to more of a strategic asset. So AI data centers, electrification, EVs are all copper intensive, and we're really headed into, a structural supply deficit. And this is a macro backdrop that makes the whole space really compelling, I see. So Teck, the company, sold, their coal business, and their Anglo merger is progressing. If it closes, they become one of the top 5 global copper producers. So this is a company really changing transformation. Last quarter, they had strong, earnings beat, copper production up 10%. The risk is really on this Blanca production guidance was cut on tailing dam issues, and the stock trades at 6 times EBITDA versus a lot of the other ones at 11 times copper. So the discount exists for a reason. I believe that copper is still one of our favorite long-term themes, but Teck can be a great way to play it, but it is a little bit show me the story. So we own the exposure, and I would say don't chase the spikes in the area.
That was Teck Resources. Let's move on to our first caller then. Bob is in Bowmanville with his question. Bob, go ahead.
Good afternoon. Brianne, I want to ask you about CNQ. When you look the way the whole energy sector has gone, up through the roof, and certainly CNQ has, do you find this to be possibly a bit rich? Would you hold, or is it still an entry point here?
Yeah, great question. And Brianne, as you know, a lot of people want to know whether they should trim energy right now or whether they should hold on because there's upside here.
Yeah, certainly. And I think, that's a great question. And I mean, last year and the year before, it was on Teck, right? And I'm a big believer in you never regret taking profits off the table. It's never a bad time if you've seen a big run up like this. Right now, just straight valuation. I mean, it's over price target upside, right? So for me, I would be taking some profits here, being a holder in CNQ. I still like the play. I still like the company. And I think that they're still going to continue to do well. And again, we own it. We did recently trim back our model weight because it has had a nice run up. So again, I would recommend that. Trading, around that $69 with a target of, down about 61. So I wouldn't be surprised to see a short-term pullback. And that's normal and healthy for the stock to be doing that. I think the stock has outrun where the street thinks it should be. I like the name longer term, but this is one where, discipline matters. Take some off the table when it runs and add on a pullback. You can see that healthy even since the beginning of the year, straight up 1 year about 55% there. So this is a stock that has historically traded well above analyst targets for long stretches. And the price line, does spend most of the last 5 years above that dotted target. So I like that. Canadian's largest oil and gas producer, essentially the blue chip of Canadian energy patch, right? Heavy oil, oil sands, conventional natural gas. They really do it all. We saw Q4 was really strong. The oil backdrop has really helped them, obviously, but the risk here is oil price sensitivity. And the fact that they delayed a major mine expansion, waiting on Ottawa's environmental policies. If oil pulls back meaningfully, I do see and would expect this stock to come with it. So I would be taking some profits here.
Good advice there. Let's move on to Dan then. Dan's in Wasaga Beach in Ontario with his question. Dan, go ahead.
Hey guys, thanks a lot for taking my call. Happy Friday. Really curious on your thoughts on Amazon. $2 trillion market cap, hitting this $200 psychological level, it seems, all the time. I'd just love your thoughts on it. Thanks a lot.
Okay, thank you for the question. Brianne, go ahead.
Yeah, thanks for the question, Dan. Amazon staple, I own Amazon in the portfolio. It's one of our core ways to get exposure to, I believe, both e-commerce and also the AI build out through cloud. Has seen, even you can see over there, 3 years, almost up 100%. The online store people know, and the AWS, which is their cloud platform, really powering a large part of the internet. And the interesting shift right now is towards the AI. AWS is becoming a key platform for companies looking to deploy AI into real world applications. So they recently did announce a major partnership with OpenAI. That's including up to $50 billion in potential investment, which really reinforces that as a central player in the AI infrastructure. This also helps the gap between AI hype and actual business use. And that's very important, and where I think the leaders are going to differentiate. This will help make it easier for companies to integrate these tools into their operation. So this is still evolving from just a cloud story to a platform enabling AI to scale. And that's why it remains still a core position for us. So we're continuing to hold Amazon through this, even though it's kind of been treading sideways. As you can see there, we still think there's more upside to run in this stock, and it's going to be a leader in the space.
Brianne, we're going to take a quick break. We'll get back to more phone calls for Brianne Gardner of Velocity Investment Partners when we return. Stay tuned. Welcome back to Market Call. We are going to the next caller. Mark is on the line. He's in Ottawa with a question for Brianne Gardner. Mark, go ahead.
Hi, Brianne. I appreciate you're very honest with your stock picks and your analysis. I would really like to know about Boyd Group. I see this as a very essential service. Vehicles are going to be wrecked, no matter if they are autonomous or regular drivers, regardless. And this is an essential business, and I'm just wondering, where is this stock going?
Okay, thank you for the question. Brianne, you can look at that line chart and see the deep dive it's done. In 2026 is where it looks like. Is there any particular reason you see that sort of downtrend there? I know tariffs might have hit it last year.
Yeah, and Boyd Group, listen, I believe in the same theory as you, but I think, we used to own Boyd. We did sell it and have not bought it back. I think there's a massive gap right now between analyst expectations for the stock and what the market is thinking as well. As you can see, the stock just got hit quite hard. And it still is, struggling, and the down about 12% on earnings day last week alone. So the market clearly disagrees with what analysts are saying right now. If we're looking at the 5-year chart, the actual price and the target line have been completely disconnected almost since late 2021. But now you're almost you're below where it has been in quite some time. They've been wrong on this name for years. They had a quite a big price target, 268 target, maybe where it eventually goes. But the market has been punishing this stock for a long time, and analysts haven't adjusted. I'd take it with a grain of salt. I think, yes, Boyd is North America's largest non-franchise collision repair operator, essentially the roll-up king of auto body shops. They run, Gerber Collision, U.S. Boyd Auto in Canada. So, you get in a fender bender, there's a good chance your insurance company sends you to Boyd shop. So they just closed on a collision acquisition in January. Big transformation deal with Joe Hudson. Integration is about 44% complete. Q4 showed some improvements. We saw a second consecutive quarter of positive same store sales growth, and margins are expanding, but full year still was actually dropped to $18 million. So again, this is why the stock got crushed on earnings day. I think the risk is repricing. Claims volumes were still down 2 to 4% in Q4. Revenue growth has been a bit sluggish too, around 2% for the year. So, it is an interesting potential turnaround story with real upside if the claims cycle normalizes and this Joe Hudson deal delivers. But right now, the street has been too early on this name for years. Again, we don't own it. If you do hold it, hold through this integration. If you don't, we'd want to see a couple of clean quarters before stepping back in.
That was for Mark. Let's move on to the next caller. Then Frank is on the line. He's in Toronto. Frank, go ahead.
Hi, Brianna. How are you doing? My question is regarding Honeywell. I took a position last year. I know in November of this year they're going to spin off an aerospace division. What are your thoughts on the parent? How's that going to affect the parent Honeywell? And what are your thoughts on Honeywell in general? Thanks very much.
Thank you for the question. Tell me about the Honeywell spinoff, if you think it's a good thing, Brianne.
Yeah, we own Honeywell, and it is also one of our picks back in September, one of my picks there. So it is a name we've had conviction on. Honeywell, is diversified industrial company operating across aerospace, automation, and building system, as Frank mentioned, basically the infrastructure behind a lot of the real economy. Really, the story right now is being driven by the aerospace, with strong demand from both air travel and ongoing maintenance that needs older fleets. But at the same time, building automation is becoming more relevant, especially with data centers, energy efficient trends supporting that demand. So they're also simplifying the business through spin-offs, which should make the company more focused and easier for the market to value. So this is not a high growth story, but a steady compounder, I believe, with exposure to several long-term industrial trends. So right now it scores a value score for us, a 9 out of 10, and a fundamental score of 8 out of 10 for us as well. So again, looking back to where, I liked it September before we saw that little peak up, you're still, we're up significantly on it, but I still think there's room to run in this story. And I still think that it's a good stock to hold.
That was for Frank. Let's move on to the next caller. Then Glenn is in Toronto with his question. Glenn, go ahead.
Hello, Brianne. Thank you for taking my call today. I would like to know if CGI is a good pick with the AI scare. Potentially devaluing the company. Do you think a CGI would be a good to add to a portfolio?
Okay, thank you for the question. It suffered from many of the software stocks worried about AI taking over. They do essentially consulting and integration. Do you think they are at risk?
I'd say it was one that was on our watch list as a more stable way to play that IT. You mentioned services, digital transformation. They still help governments and large companies run and modernize their IT systems, from consulting to actually managing operations. I think what makes this stock interesting is the model. A big part of the business is long-term outsourcing contracts, often 5 years or more, which creates, for me, I see very stable and reoccurring revenue, and that's great for a stock. So you're also seeing real adoption of their software. They recently upgraded the City of Austin's financial system to a cloud-based platform, showing how governments are moving towards more modern SaaS solutions. I think the opportunity is really tied to AI and digital transformation. Companies still need to modernize their systems before they can fully adopt AI, and that plays directly into CGI's strength. So the challenge is the environment, right? Spending has been slower, especially when large clients delay projects, higher costs. So growth depends on that cycle turning. So that would be something that I'd be watching for. Again, I don't own this stock, but it has certainly been on our radar.
Let's take a quick break then. We'll come back with past pick from Brianne in just a moment. Stay tuned. Time now to go through past picks with Brianne Gardner from March 19th of last year, so a year ago. Meta Platforms was your first choice at the time. On the NASDAQ, it was 584.06 US to 530.66 today, so downside of 9%, 8% down for total return. All the Mag 7 we know have been less popular and been dragged down. Brianne, have you held onto a position in Meta Platform, or have you trimmed it all?
We have held. We actually added, and I still think Meta is a stock that I like, and we continue to hold. And what we're seeing is, as you mentioned, really a reaction to headlines, not a change in the core business of Meta. People didn't stop using Instagram, and advertisers didn't just walk away. The market is repricing risk, especially around a lot of regulations. But that doesn't mean the model is broken. Just that uncertainty is a bit higher. And I mean, if you look at Meta historically, it's a company that has adapted every time that there's been a challenge. It moved from desktop to mobile, from feed to reels, and now it's moving into AI-driven engagement. And I think the bigger story is still ahead. They're investing heavily into AI and new modernized channels, which can drive the next phase of growth. So while there may be some volatility, and this short term, I see that as an opportunity, and we are still very strong. They still have a very strong platform, massive scale, and long-term growth tactic. So upside potential right now, we see about 57% with a price target of 860, ranks a 9 out of 10 for us. Even earnings growth, 3-year about 40%, and still revenue growth, 3-year about 20%. So again, this is a stock we're going to continue to ride.
Are you concerned at all about the recent judgments in the U.S. where they do have to pay or have been found liable to pay for injuries to mental health? We know this is just the beginning of the cases that will be sort of unleashed to come. Does that weigh in on your forward thinking for Meta at all?
You know what? I think for example, for Meta, they are, a leader in that. And yes, I think this is great for this to come to fruition of that something does need to change, especially in the AI world, when it does come to mental health or health concerns of anyone that is using that. So I think this is just a standard that needs to be set. And, I think, yes, sure, there might be some fines, but I think that they will be very quickly to adapt, have those precautions, make sure that they are doing the right thing and ahead and on this. So I don't see it as a long-term impact to the stock price.
Let's get to your next past pick then. Costco was your second pick from last March. Cost, of course, on the NASDAQ, 904.05 US at the time to 984.13 today, so 8% upside, and then 9% total return. I've heard other people raise fears about valuation here. What are your thoughts for holding on to Costco?
Yeah, Costco is a stock we still like to hold. I mean, in the consumer staple place area, when people panic or get concerned about market volatility or recession or anything like that, Costco will be a leader. As you can see, the nice run up that it's had since January has been kind of trending sideways. So, this is going to indicate which direction this stock can go. For me, what makes it stand out is their business model, right? This isn't a retail, it's a membership driven model. They have that recurring revenue I love to see in businesses, and very strong visibility. I think also secondly is the loyalty is exceptional. Their renewal rate is close to 90%. So customers consistently come back, which gives the business a very stable base. And third, they have a real pricing advantage. Everything is built around keeping costs low. And in uncertainty environments, that's naturally drives more traffic to them. So again, they continue to gain market share. So yes, you're getting a company that combines defensiveness with a steady growth. And that's exactly the kind of name that we like to own in this type of market. So from a valuation standpoint, yes, I still see double digit upside from here, about 11 to 12%. Again, that could change and alter. Right now, fundamentally, the stock ranks a 10 out of 10 for us. Even over the past 3 and 5 years, their earnings growth has been double digits, and same thing, revenue growth over the last 3 and 5 years up about 7 to 10.5%. So again, a company that we want to continue to hold in our portfolio.
Let's get to Eli Lilly then, which was your third pick from last year. It was at 837.01 US. Now it's at 887.80. 6% upside, 7% total return. Concerns about who's winning the war with the weight loss drugs. Do you continue to hold and like Eli Lilly?
Yeah, I think if you look at what happened last year and the pivot that we've seen drastically in the economy and, a war that we're currently facing, there's been a lot of moving pieces. And to, strategically pick some winners in this type of environment hasn't always been easy. But I think that's where the diversification comes in. And Eli Lilly in the healthcare space is one that we want to continue to own. And what we're seeing recently is more about expectations settling after a very strong run up, as you can see, kind of since those August lows there. Not a story changing for this company. This is still a company that is at the center of the biggest shifts in healthcare. As you mentioned, treating obesity, diabetes, where demand continues to grow globally. And what builds our confidence is how they're building beyond that. They're expanding into areas like Alzheimer's, opening the door to another large market over time, and at the same time making treatments easier and to use and invest in, which is great, bringing those costs down and reaching more patients. So instead of being pressured by competition, they're actually growing the market and staying ahead of it. And that's really the key. This is a company that keeps expanding its opportunity set, and that's why we are comfortable continuing to hold Eli Lilly. And I like their story still.
Let's take a quick break. We'll go back to the phone calls in just a moment. Stay tuned. Welcome back. Michael's on the line in Toronto. He's got a question today for Brianne Gardner. Michael, go ahead.
Hi, Marilla. Hi, Brianne. Thanks for taking my call. Great show as always. My question is on Fortis. What's your take on Fortis as a utility pick for the long term? Would you buy, hold, or do you prefer another utility in that space?
Okay. Thank you for the question. Brianne, go ahead. What are your thoughts on the utility space right now?
Yeah. I think we owned Fortis in the past and took our profits. And Fortis is still one of the largest regulated electric and gas utilities in North America. Their Q4 earnings beat by about 6%, and revenue was up about 11% year over year. So they did get a massive $26 billion capital plan through 2029, growing the rate base at about 6.5% compounding. Not exciting, but still reliable. The dividend, I believe, is still solid, 3.3%, that they do try to grow each year, 51 consecutive years of payments. And, this is a bond proxy, not really a growth story. You're paying 22 times forward earnings for mid-single digit growth near the 52-week high. So the stock and, where analysts are saying have been trading right on top of each other for the last couple of years. I think analysts are pretty dialed on this. Right now, you're seeing, fundamentally ranks an 8 out of 10. They're seeing it's hitting the price target right now. You're seeing mixed reviews kind of between buy, hold, or, sell or underperform. So a little bit in the middle. No massive upside disconnect. So Fortis is the definition, I would say, of a sleep at night stock. Yes, we owned it. We took our profits and we moved on to names with more upside. If you own it for dividend and that's your purpose, or a sleep at night stock, you can continue to hold it. If you're looking to buy it, I'd certainly wait for a pullback, ideally under that $70. In a good run, if you're looking for utility exposure in Canada, we prefer, I'd say, infrastructure plays like BIP.UN that we hold in our portfolio.
Michael, I hope that works for you. Let's move on to Roman in Edmonton. Roman, go ahead. Roman, are you there? Okay, we may have lost Roman. We'll see if we can get him back. Let's go to Jacob in Toronto. Jacob, do you have a question?
Hello, yes. Good afternoon to both of you. Andrea, can I ask you about Brookfield Corporation? I was going to ask for Brookfield management, but I made a mistake in midstream. I don't want to change. However, whatever you're comfortable with, answer me, please.
Thank you for the question. Okay.
Thank you.
Thank you for the question. Let's have a look at Brookfield Corp, pulling it up here. Brianne, of the Brookfields, is there one you prefer over the other?
I trade them kind of all throughout different ones. But I'd say right now, I don't own Brookfield Corp in the portfolio. We owned and traded this stock in the past. I mean, their stock is currently trading at about 22% discount to its net asset value, which historically has been a decent entry point. We know Bill Ackman's Pershing Square has it at their top holding. I think Brookfield is essentially, the Berkshire Hathaway of real assets. And they manage over $600 billion in fee-bearing capital across infrastructure, renewable energy, all of those, right? So that's something that we're certainly watching. If it's a real asset that underpins the economy, Brookfield probably owns or manages some of it. Q4 was strong, record distribution earnings, and they hiked their dividend, and their wealth solutions and insurance segment is the new growth engine of this business. So the AI angle is interesting. One of their subsidiaries that they're doing, which plays into their core strength in the real assets that they like to own. The risk is really their complexity, right? As Brookfield is notorious hard to value when it's sprawling structure. Real estate values drop 50%, and their discount to NAV suggests that the market doesn't fully trust their stated book value. So interest rate sensitivity also matters here. So looking at the 5-year chart, I'd be a little cautious. The current gap between that 55 to 73 price target is one of the widest we've seen. And Brookfield is one of the best run alternative managers in the world, but you're getting a meaningful discount to NAV. So it's not in our portfolio, but I would say it's likely to be a decent long-term hold.
That was for Jacob. Let's go on to Roman. He's back on the line. Roman, what's your question?
Yes. Lundin Gold, LUG.
What about it? Anything specific?
No, that's LUG.
Just an assessment. Okay. So Lundin Gold has been down 23% as many of the gold stocks pulled back over the last month with the conflict in Iran. If you're holding something that's connected to gold, Brianne, what would you do?
I don't own Lundin Gold. We certainly follow it closely. As you mentioned, has seen a slight pullback. The whole gold space is correlated, and we have exposure through Barrick, Wheaton, precious metals, etc. Sometimes I like just buying some gold ETFs to have that liquidity, but get the exposure. I think this stock, we've seen that pullback roughly 25% from its highs, which is in the range of many in that sector. It's a single mine gold producer. They own and mine in Ecuador. The numbers are impressive. Strong production, 71% margin, revenue up 38%, net income 53%, really record earnings. And they just declared, a quarterly dividend and are paying about 100% of normalized free cash flow. That yield is close to 4%. So they are ramping things up, right? The risk, again, is the single asset concentration in Ecuador, political and operational risk in one mine. Barrick gives you global diversification across multiple mines and jurisdiction. So they recently did, I would say big picture is Lundin Gold is, phenomenal mine with phenomenal economics, but it's one mine in one country. I prefer, some of the others for our gold exposure because you get diversification and multiple ways to win. If you want a concentrated high grade gold bet and you can stomach the single asset risk and swings, London is certainly one of the best, but I would say size accordingly and make sure you're not over concentrated.
Let's move on then to Alan, who's been holding on the line in Kitchener, Ontario. Alan, go ahead.
Your thoughts on Uber? Thank you.
Okay, very quick questions today on a Friday. Uber, of course, is partnering and announced a deal to move into the autonomous space, the autonomous driving space. What do you think of Uber's model in a partnership with some of these other companies that are moving that way?
Yeah, I don't own Uber, but it's on our watch list and we traded it a few times. And I think, this is a unique way to play also mobility, delivery, and that autonomous driving that you mentioned, Marella, right? Like Uber is essentially a platform that connects drivers or riders, drivers, and delivery services, really acting as almost a middle layer that makes all of that work. So what makes this interesting is their model shift. They've moved from a high growth story to focusing on profitability, efficiency, which has changed how the market looks at this business. The bigger opportunity I see is that autonomous driving. Uber isn't building the cars. they're positioning themselves as the network that can bring the demand, which could make them the operating system for robo-taxis. So that's where partnerships come in, as you mentioned. They're expanding relationships with NVIDIA is a good example, targeting deployment across 28 cities globally by 2028, showing how serious this roadmap is. So the story is really shifting from just ride sharing to becoming the platform the monetizes automation fleets, which is the much bigger long-term opportunity. So I do like Uber. Not one that we do own, but it's on our watch list.
Let's take a quick break, Brianne. We'll be back with more questions for Brianne when we return. Stay tuned. Welcome back. Ghulam's on the line in Toronto with a question today for Brianne. Ghulam, go ahead.
Hi, good afternoon. My question is on Propel Holdings. I bought that when it had a big drop a couple of months ago. It is still dropping. My question is whether I should hold on to it, sell it for tax loss, or buy some more and average my costs down. I'd appreciate your opinion.
Okay.
Thank you.
Good to get that question because we haven't touched on sort of private credit and that space today. Brianne, what are your thoughts on Propel?
Yeah, I think the private credit space has been under pressure certainly lately. I don't own Propel, more small cap fintech, but Raymond James does cover it, and they have an outperform rating of a price target of about $32 per share. And fundamentally, it ranks actually a 9 out of 10 for me. So it looks like attractive valuation right now. That's about 70% implied upside. From an owning perspective, I'm not sure the weight that you have, your cost base, any of those things. I would always say, cautious of over allocation from a concentration level. But, if you have a decent amount and like 2% and you're looking to add, this wouldn't be a bad time. I think every single analyst has a buy rating right now on the street, but the stock has been cut roughly in half from its all-time highs. So the market is clearly worried about something that analysts aren't. This company essentially is a digital alternative to payday lenders. So they use AI to underwrite loans and lines of credit for people who can't get approved at traditional banks. Their Q4 earnings miss was a little bit ugly. Their provision for credit losses spiked to nearly 57% of their revenue. Management said it was timing. They saw a surge in December operating that required upfront provisions, not fundamental. So again, I think the growth story is still real. Revenue up over 20% last year, record expansion, and the risk is obvious. It's, subprime lending. So big picture, high reward, high risk, small cap tech, fintech, and the growth of this valuation is compelling, but you need to understand what you're buying. I think there is some certainly risk there.
Some thinking to do for Propel Holdings. Let's get to Dale. Dale's in Bridgewater, Nova Scotia with his question. Dale, go ahead.
Hi, Raymond, Brianne. I appreciate you taking my call. I just got a general question for you. I went to about 40% cash about 2 weeks before Trump went on his excursion over to the Middle East. And I'm just wondering what signals you use to get back into a market and what kind of measures do you use to use an entry point? I'll hang up and listen. Thank you.
Great question. Are you fully invested at this point, your whole cash?
We hold cash in our portfolios. I'd say we're at about 7 to 10%, 11% cash. And 40%, yes, is a little bit higher. We have had 4 20% corrections in the past 7 years. So that's a fairly, quite a bit. And we're at a 7% pullback right now that could turn potentially, who knows, into a 15 to 20% pullback if energy prices cause an economic slowdown or we start to see sticky inflation. We're holding some cash, not 40%, but it also depends on your equity exposure and risk tolerance. If you're fully invested in 100% stocks, then 40% cash right now is a good time to start strategically picking up some, I'd say, international exposure, value positions, financials, et cetera, some materials, but don't overpay for those things. I think individual stocks, if you're seeing the market down 7, you're seeing individual stocks pulling back anywhere between 50 to 30%. So there's lots of opportunity to pick up half positions now and tranche into the market in stages. We look at both fundamental and technical, technical for entry points and fundamental for what business is and companies we want to invest in. I think for any new clients that, for example, give us cash today, we have them about 50 to 60% of their total targeted equity now. If someone was already 50%, we'd have them up to about 75% of the way there. But again, it all depends on risk tolerance. So I would be tranching into this market, because if we're headed into a double-digit correction, this could be the only double-digit correction we're going to get for 2026.
All right, let's leave it there. We do have to take a break. We'll take a look at new picks from Brianne Gardner when we come back. Join us on Monday for Market Call. Dan Rohinton will be on the show, Vice President and Portfolio Manager. He will be taking your questions on Canadian and global large caps. He is with IA Global Asset Management. Let's get to some new top picks from Brianne. We're going to start with Wheaton Precious Metals, WPM on the TSX. They reported recently and have done quite well. Tell me a little bit more about what you like about Wheaton, because they're not in mining per se, they're in royalties, yes?
You got it. And, I've mentioned this stock a few times throughout the show, but I think we've been leaning more towards royalties and streaming companies rather than traditional miners, as you mentioned. Commodity prices have been strong, but we still want to see that translate into consistent profitability from miners. And that's where I see Wheaton and where they stand out. Even if gold prices become more volatile, Wheaton is in a very strong position. Their model gives them exposure to the upside, but with a lower cost and more predictable margins since they're not operating the mines. On top of that, they have a clean balance sheet, strong cash flow, no debt, which gives them flexibility through different price environments. So for me, it's a way to stay exposed to gold, but with more stability and less execution rich, which is why exactly we want to own it right now. We see about 56% upside from here with a price target of $257.
Interesting. Okay, let's get to your next pick then. IBM on the New York Stock Exchange. What are you liking about this name? Everybody knows.
Yeah, IBM is a name we like because it's growing from multiple angles while still landing in a reasonable valuation. At the core, they run some of the world's most critical system. So you already have a very stable and embedded business. And on top of that, they're building new growth drivers. Their consulting business is helping companies actually implement AI, which is where the real spending is happening. They're also strong in hybrid cloud, helping companies manage data across different environments. And then you have the quantum computing. It's early, but they're already using it to design new real materials, which can speed up innovation and things like energy, healthcare, manufacturing. So for me, you're getting all of that in at around 19 times earnings, which is an attractive for this kind of story. I see a 30% upside from here with a price target of about $317 to go.
Wondering what that drop off in February has been for this company.
Yeah, I think we saw a little bit of a pullback, and same thing in the tech space. Start of the year, we saw some rotation, some profit taking, and I think IBM also followed that suit as well.
All right, let's get to your third pick then, which is Analog Devices, so ADI on the NASDAQ. Tell me a bit about them.
Yeah, ADI, they're a name we like because it's quietly becoming a key enabler of AI infrastructure. What's interesting is not their flashy chip name, but that they're essential in how data centers actually function. So these servers need more power, more control, more efficiency, and that's where ADI plays. They make the components that help move and manage electricity inside data centers as AI gets more complex. You can already see it in the business. Data center and related segments are now about 20% of revenue and strongly growing. And beyond AI, they're also exposed to long-term themes like automation, electrification, industrial recovery, which gives you multiple growth drivers. So for me, it's a company with strong margins, increasing content, and exposure to long-term trends, but still not as crowded as some of the other AI upside names. So I see about 25% upside here. Again, majority on the street, you can see a buy from analysts, and looking at a price target, we're seeing about that 391. So ranks at 10 out of 10 for me from a value score.
How often do you get a 10 out of 10?
Rarely, but it doesn't always mean it's going to be 100% of a winner. But when we look at fundamentals and technicals, and it does hit a 10 out of 10, then it becomes a timing matter of, can we get in the stock? Is there still room and upside? Still seeing double digits, 25% from here. I think this is a great company that we're going to have a nice run. Year to date up already 16%. Looking at 12 months, the stock's up 53.
Yep.
So even after that, I think that this is going to be a play that you can still participate in.
Got it. Brianne Gardner, got to leave it there. Thanks as always. Good to see you.
Thanks for having me as always, Marilla.
And thank you for joining us today in Market Call. We'll see you back here on Monday.